Anoka Hennepin Credit Union is pleased to bring you credit, credit cards, credit score, and loans. During this training, you will learn the basics of how credit is and how it works and affects your life. You will also gain some insight into the power of credit cards and how they can benefit you, but also negatively impact your life. Participants will also gain a more thorough understanding of credit scores and why it is considered a GPA for life. Finally, also contingent on your use of credit in history is the details on what someone must do to obtain a loan and the impact of credit on loans. Well, when we watched our parents making purchases with a shiny card and not money, we had no idea the power a piece of plastic had. What is credit? Whenever you make a purchase today for the promise of paying tomorrow, you are using credit for that purchase. Credit has been standardized over the years. Most stores make you pay on the spot with cash, debit, or credit cards. Big banks control credit and whether you can have a credit card and how much you can use. Banks must first approve you, ensuring that you can be trusted to repay the amount of credit you can use. This is considered financial trustworthiness. Credit and lenders. Lenders use a number of factors to determine your financial trustworthiness. Credit history is the most commonly used. Lenders consider income and requires at least 2 weeks of pay stubs. This is proof you have the means to repay the loan. A lender may also require a cosigner for new borrowers or those with credit issues. How does credit work? To establish credit with a financial institution, you must first fill out an application. The lender will need identifying information like Social Security number to look up your credit history with credit bureaus. Credit bureaus or credit reporting agencies are companies who keep track of your credit history. They also track the number of credit accounts you've had, the amount you've borrowed, and whether your payments were late or on time. Once approved, you will get guidelines and terms for using the credit. The terms include amount borrowed, credit limits, repayment options, late fees, and finance charges. Usually, the lender establishes a maximum amount of credit that you can use, a credit limit, based on your credit history. Your credit terms will outline what often happens if you exceed your limit. In some cases, a penalty will be assessed. When approved for revolving credit, you can use over and over. The lender will provide you with a way to use it like a credit card or a checkbook. You will receive a periodic billing statement from your lender detailing purchases, interest charged, minimum payment due, and payment due date. You must make payments by the due date to avoid any penalties. Credit cards. A credit card is a plastic card that lets you access the credit limit your credit card issuer has given you. A credit limit is like a loan, but instead of giving you the full loan in cash, the bank lets you take as much as your approved credit limit will allow. Each time you make a purchase with your credit card, your available credit goes down by that amount. What makes a credit card different from a regular loan is that when you pay back the balance, your credit limit is available again for you to use. You can spend and repay as much as you want as long as you abide by the credit card terms. Make your payments on time and don't charge more than your limit. Because you can keep using your credit over time, credit cards are sometimes referred to as revolving accounts or open-ended accounts. The card issuer gives you a certain amount of time to pay when you've borrowed before they charge interest. This period of time, which is called a grace period, is usually 20 to 25 days. If you don't pay the full balance before the end of the grace period, a finance charge is added to your balance. Cost of charging on credit cards. The finance charge is usually based on your interest rate and your balance. Credit cards have an interest rate, which is the annual rate you pay for borrowing money on your credit card. Interest rates are generally based on market interest rates, your credit history, and the type of credit card you have. If you have a good history of paying back your credit card bills, you'll usually qualify for lower interest rates. You have to pay your balance in full if you want to avoid paying interest. The issuer usually doesn't require you to pay back all of what you owe at once, but you must pay the minimum payment by the due date to avoid a late penalty. Paying the minimum is the slowest and most expensive way to pay off your credit card balance. Credit card and activity. Each month, the credit card issuer will send you a billing statement that includes your minimum payment, the due date, and a list of transactions that you have been posted to your account. It's a good idea to review these transactions to make sure they're all transactions that you personally made. You also want to make sure that your last payment was correctly applied to your account. If any fees have been added to your balance, make sure they are legitimate. A check card or a debit card will also have 16 digits. However, these purchases are taken directly from a checking account. Prepaid cards and gift cards also look like credit cards, but purchases are deducted from the prepaid or gift balance. Credit score. Did you know that all your credit card payments and non-payments are compiled into a single document known as your credit report? Did you also know that the information in this report is given a numerical value called a credit score? Credit score is a numerical summary contained in your credit report. Lenders make a credit decision about you based on this score. Your credit score is calculated based on the information in your credit report. The more negative information on your credit report, the lower your credit score will be. The 6 worst credit report entries are charge-offs, debt collections, bankruptcy, foreclosure, tax liens, and judgments. When you apply for a credit card, either your credit report and/or your credit score are checked to see if you have a history of late payments on credit cards. Mortgage lenders check your credit report for previous loan defaults. Even the power company checks your credit report and score before turning on your electrical service. Credit report. Your credit report includes your specific demographic, employment, payment, bankruptcy, and legal judgment information. Your report is maintained by credit bureaus. There are 3 major credit bureaus: Equifax, Experian, and TransUnion. Credit unions collect information from credit card companies, banks, and almost anyone with whom you have an agreement to pay. The information is compiled and sold to businesses who want to view the information to make a credit decision about you. The Fair Credit Reporting Act limits the businesses that can access your credit report to those who have permissible purpose. Your creditors and lenders send information about your account to these credit bureaus. This includes monthly payment status, account balance, credit limit, account status, and other information to determine credit worthiness. Once it's on our credit report, it's available for future creditors and lenders to see. Checking your credit report periodically is important for maintaining financial health. You can obtain a copy of your credit report from each of the 3 credit bureaus each year. The Fair Credit Reporting Act allows you to order a free copy of your credit report each year. GPA for life, your credit score. A credit score is a numerical summary of your credit report to simplify decision making and make it less subjective. Credit scores range from 300 to 850 and assists creditors and lenders in a risk assessment to extending you loan or credit. Consumers with higher credit scores are considered less risky borrowers than those with lower scores. Higher credit scores will allow you to get lower interest rates on credit cards and loans. Generally, the lower the credit score, the higher the interest rates. There are many different versions of the credit score. The most widely used is the FICO score, named after the Fair Isaac Corporation, credited with developing the score. All 3 bureaus have their own version of the FICO score. Equifax uses Beacon, Experian uses Experian/Fair Isaac, and TransUnion uses Empirica. Credit scores aren't included in the free annual credit report benefit enforced by Fair Credit Reporting Act. You must purchase them from the credit bureaus using your credit report or from myfico.com. Each piece of credit history is given different weights in calculating your score. Payment history is given 35%, debt level 30%, length of credit history 15%, inquiries 10%, and mix of credit 10%. Loans. A loan is a money that's been given from one person or an institution to another with the promise to repay. A loan contract is a written agreement that describes how and when you will repay the money. In a sense, credit is then the trust of belief that you'll repay the money you borrow. You have good credit when lenders believe you'll repay your debts and other financial obligations on time. Bad credit indicates you're not likely to pay your bills on time. Your payments or a loan and even the borrowing of the loan impact your credit score. Loan applications. Simply applying for a loan can lower your credit score. Due to reporting mechanism for each application, your credit report will reflect how many applications you have submitted in a 12-month period. Several inquiries indicate you are desperate for a loan. If you are shopping for a mortgage loan or an auto loan, you have a grace period in which those inquiries don't affect your credit score. When done rate shopping, the loan inquiries are treated as a single application rather than several. The window of time is between 14 and 45 days, depending on which credit score the lender is using. That is a very important factor. 5 types of loans. There are many types of loans you can take out. It's important to know your options. Open-ended loans are loans that you can borrow over and over. Credit cards and lines of credits are the most common types of these loans. Closed-end loans cannot be borrowed once they've been repaid. As you make payments on closed-ended loans, the balance goes down. However, you don't have the available credit after making payments. Common closed-end loans are home, auto, and student loans. In the event of a loan default, the lender can take possession of the asset. Interest rates for secured loans can be lower than unsecured loans. Unsecured loans do not have assets for being used as collateral. These loans may be more difficult to get and have higher interest rates. Unsecured loans rely solely on your credit history and your income to qualify for a loan. If you default on the loan, the lender has to exhaust collection options. Conventional options when it comes to mortgage loans other than conventional loan is often used. Conventional loans aren't insured by the government agency like the Federal Housing Authority. Conventional loans may be conforming, meaning they follow guidelines set forth by Fannie Mae and Freddie Mac. Other loan information. Your loan payments have a significant impact on your credit. As I mentioned earlier, when it comes to a credit score, payment history is 35% of your credit score. Timely loan payments make you a more attractive borrower. Late payments will damage your credit score. The balance of your loan will influence your credit. You gain credit score points as you pay down your balance. Your debt-to-income ratio is comparing all of your loans and credit cards to your total income. A high debt-to-income ratio makes you more of a risk to a lender.